Every time the US dollar slides, global markets get nervous. But what if the leader of the world's largest economy openly shrugs off its decline, and investors interpret that shrug as a green light for further weakness? That's exactly what's happening right now. And it's reverberating through stocks, commodities like gold and oil, forex markets, and even central banks around the world. Today, we're unpacking the news that the US dollar extended its fall after President Trump dismissed concerns about a weaker currency, why it matters, and what it could mean for you as an investor, trader, or saver in 2026. What's happening with the US dollar right now? Recently, the US dollar index, DXY, which measures the value of the dollar against a basket of 6 major currencies, has been under sustained pressure. The dollar has slid to its lowest level in nearly 4 years, extended losses through multiple trading sessions, and trades below key psychological levels around 97.5 to 98. Markets interpreted remarks from President Donald Trump, where he dismissed concerns over the currency's slide and said the dollar was great, as a tacit signal that the administration is comfortable with or even indifferent to further depreciation. Traders moved quickly. Currency pairs like NZD, USD, and USD CHF rallied, supporting the thesis that the dollar's weakness is broad-based. So why is the dollar falling? The US dollar doesn't lose value in a vacuum. Several factors have converged. 1. Political signals from the White House. Trump's public comments, especially telling reporters he thought the dollar's decline was great while dismissing concerns, were taken by markets as a sign the administration isn't worried about a weaker greenback. That's a big deal because confidence in a currency often depends on leadership communicating stability. When leaders signal they don't care about a currency's weakness, traders sometimes take that as an invitation to push it further lower. 2. Policy uncertainty and trade turmoil. Uncertainty over trade and tariff policy is another driver of dollar weakness. After the U.S. Supreme Court struck down parts of Trump's wide-ranging tariff authority, markets reacted negatively, extending losses for the dollar as policy confusion worsened. Even as Trump threatened to reimpose tariffs through other provisions, the lack of clarity added to risk aversion and currency volatility. 3. Broader market. Sentiment and risk appetite. When global investors feel more comfortable taking risk, they tend to move money out of safe haven assets like the US dollar and into higher yielding or higher growth assets such as equities or even emerging market currencies. Examples include the NZD increasing against the dollar after Trump's State of the Union address and economic policy remarks. 4. Weakening safe haven status of the dollar. According to a recent report from ING, the dollar has lost some of its safe haven appeal, not because it's fundamentally unstable, but due to persistent policy uncertainty and international reactions to the U.S. stance. Despite the drop, long-term confidence still prevails. Private investors still hold a large share of U.S. assets, but the sentiment shift is notable. Trump's comments and market interpretation. Trump's remarks to reporters essentially boiled down to, the value of the dollar is great. I think the dollar should find its own level. When you're the leader of the U.S., that's not neutral economics talk. That's policy signaling. Markets took it as a signal the administration might be comfortable with a weaker dollar, a hint that some policymakers may prioritize export competitiveness over currency strength, and an implicit suggestion that monetary policy might remain accommodative. Investors and strategists interpreted these remarks as contributing to the dollar's slide into its lowest level since early 2022. What a weaker dollar means for other markets. 1. Stocks. A weaker dollar can lift U.S. stocks, especially multinational companies, because revenues earned overseas translate into more dollars when the dollar is weaker, boosting earnings. Export-focused companies become more competitive globally. However, the impact isn't always straightforward. If the dollar weakens too much, it can signal deeper economic problems, like inflation or falling confidence, which might weigh on valuations. 2. Commodities. Gold, oil, silver. A falling dollar typically boosts commodities for a few reasons. Commodities are priced in dollars globally. A weaker dollar makes them cheaper for foreign buyers, supporting demand. For example, gold has been rising as the dollar tumbles, breaking above key levels recently as traders seek a hedge against currency devaluation. Similarly, oil prices often climb on dollar weakness because producers receive more valuable currency for their barrels in non-dollar terms. 3. Forex and emerging markets. As the dollar weakens, many emerging market currencies tend to strengthen, at least relatively, supporting global demand and easing balance of payments pressures in some countries. For example, NZD USD has risen as the US dollar weakened following key policy speeches. Currencies like the yen and euro have also gained ground against the dollar amid sustained selling. Inflation and the weaker dollar. A weaker dollar can put upward pressure on inflation because imported goods become more expensive. Imported inputs for U.S. producers cost more. Consumer purchasing power erodes. This dynamic might complicate the Federal Reserve's policy decisions, especially if inflation does not pull back as expected. Yet the White House has reinforced that despite tariff challenges and currency weakness, monetary policy remains in the Fed's hands, and there's no immediate pressure to shift interest rate strategies. Is this a short-term drop or a structural shift? One of the biggest debates now is whether the dollar S as decline is a short-term reaction to political uncertainty, tariff news, and comments from leaders, or the beginning of a structural weakening trend, influenced by policy direction, fiscal deficits, and long-term economic shifts. Some analysts say the slide could be cyclical, a reaction to current uncertainty, without indicating a departure from the dollar OS reserve currency status. Others point to evolving fiscal and trade policy dynamics, suggesting the decline might extend if confidence in monetary policy independence erodes further. How investors are adjusting. In reaction to these developments, currency traders are positioning for further dollar volatility. Commodities traders are watching gold and oil for inflation hedging behavior. Equity strategists are reassessing overseas earnings translations. Emerging markets are capitalizing on relatively stronger currencies. Risk management becomes critical in times like this due to cross-asset impacts. Potential future scenarios. Let's explore how this could unfold in the coming months. Scenario 1. Dollar stabilizes. If policy clarity improves and markets regain confidence, the dollar could bounce back from recent lows. Scenario 2. Continued slide. If political messaging continues to signal tolerance for a weaker dollar and fiscal concerns rise, the downward trend could persist. Scenario 3. Volatility spikes. Geopolitical turmoil, global recession fears, or unexpected policy shifts could make the dollar's path highly unpredictable. Broader implications. A sustained weaker dollar could have implications beyond markets. Consumers may face higher prices on imports. Global trade flows might adjust as U.S. goods become cheaper abroad. Central banks might recalibrate reserve holdings if confidence shifts. International investment flows could rebalance as currency risk changes. Despite weakness, the dollar remains central to global finance, but perception matters as much as fundamentals. What you should take away. Here's the bottom line. The US dollar is extending its fall, hitting multi-year lows. President Trump's comments, signaling comfort with a weaker currency, have added momentum to the slide. Markets are watching global reactions, commodities, and Forex outcomes. Inflation, trade policy, and investor confidence are the key variables shaping what comes next. You don't need to predict the exact path. But understanding how currency sentiment, political rhetoric, and economic fundamentals interact is essential for navigating markets in 2026. Before you go, tell us in the comments, do you think the dollar will keep sliding, or is this just a temporary wobble? If you found this breakdown helpful, subscribe to the channel and share for more market insights.